Welcome to GRE. I'm your host, Keith Weinhold. What's the state of the housing market for the next 5 years, and could what's happening in the foreclosure market affect it? I see relative housing market price stability. My guest sees cracks. This could be somewhat of a debate today. Then, two great new cash-flowing real estate markets in the same state that we're helping your portfolio with on Get Rich Education. Mid-South homebuyers, they're total pros. With over 2 decades as the nation's highest-rated turnkey provider, their empathetic property managers use your ROI as their North Star, so it's no wonder that smart investors just keep lining up to get their completely renovated income properties like it's the newest iPhone. They're headquartered in Memphis and have globally attractive cash flows, an A-plus rating with the Better Business Bureau, and now over 5,000 houses renovated. There's zero markup on maintenance, let that sink in, and they average a 98.9% occupancy rate, while their average renter stays more than 3.5 years. Every home they offer has brand new components, a bumper-to-bumper 1-year warranty, new 30-year roofs, and, wait for it, a high-quality renter. Remember that part? And in an astounding price range, $100 to $180K. I've personally toured their office and their properties in person in Memphis. Get to know Mid-South. Enjoy cash flow from day one. Start yourself right now at midsouthhomebuyers.com. That's midsouthhomebuyers.com.
You're listening to the show that has created more financial freedom than nearly any show in the world. This is Get Rich Education.
Welcome to GRE from Edison, New Jersey to Edinburgh, Scotland, where I am today, and across 188 nations worldwide. I'm Keith Weinhold, and you are back for another wealth-building week on Get Rich Education. Today's guest came to me recommended. It came from a guest that we've had on the show here before, Jim Rickards, and his daughter, Allie Rickards. His name is Christopher Whalen. He has a distinguished background, comes from a prominent family, and he's the author of a new book that just published a few weeks ago. His father, Richard Whalen, was the biographer of Joe Kennedy and was advisor to presidents and Fed chairman. And today's guest, his son there, Chris, he has done a lot of work in D.C. He lives just north of New York City today. So I guess coming recommended from Jim Rickards and learning a few things about today's guest helped me want to host him on the show. So though I'm just meeting him for the first time right here on the show, as it turns out, I learned that he has mentioned on other channels that real estate prices could correct down 20% and fall back to 2020 levels. I absolutely don't see how that's possible in any way. I'm going to bring that up with him, so we'll see. This could turn into somewhat of a debate. Like I said last week, I believe that significantly falling housing prices, that's about as likely as grocery store prices falling back to 2020 levels. Yes, I am in Edinburgh, Scotland today. It's my first time here. My mom, dad, and also my brother's entire family came over from the U.S. to meet up. It's been great. We're taking in all the best sites, Edinburgh Castle, other castles, the Scottish Highlands, Loch Ness, though I don't believe in any Loch Ness monster at all. Come on, what a hoax. And we're seeing some other sites. Though it didn't really interest the others, which I could understand, I visited the home where Adam Smith once resided, and I might put my video about that on our Get Rich Education YouTube channel, so you could check that out over there. Of course, Adam Smith is considered the father of modern-day economics for his work on supply versus demand and the GDP concept, the invisible hand concept. Much of that work conveyed in his magnum opus, The Wealth of Nations, published in 1776. As for the present day, let's meet this week's guest, including me meeting him for the first time. I'd like to welcome in a first-time guest. He's the author of a widely acclaimed new book. It's named Inflated: Money, Debt, and the American Dream. It just released, and the book couldn't be more timely with the multitude of challenges related to inflation, many involving the housing market. In his earlier books, he's been known, frankly, for just telling his readers the truth. He's worked at the Federal Reserve Bank of New York, in politics, and as an investment banker for more than 30 years. Today, he runs Whalen Global Advisors. You've seen him on CNBC and the Wall Street Journal, and now you're hearing him on GRE. Welcome to the show, Chris Whalen.
Thank you, Keith. Appreciate your invitation.
Whalen is spelled Whalen if you're listening in the audio only. And Chris, we're in a really interesting time in the economic cycle. We all know the Fed has a dual mandate: high employment and stable prices. What's interesting to me is late last year, they cut rates by a full 1%, and this is despite inflation being above target. Makes me wonder if they care more about high employment and they're rather willing to let inflation float higher. What are your thoughts?
I think historically that's been the case. You know, the dual mandate, Humphrey Hawkins, that drives the Fed's actions today, was a largely socialist compromise between the Republicans and the Democrats. The Democrats wanted to guarantee everybody a job after World War II. The legislation was really about soldiers and people who had served their country in many, places around the world for a long time. And then you would have the Depression. So you had a whole generation or more of people that were looking for help when they came home. And that's what this was. But today, there's another mandate, which is called keeping the Treasury bond market open. We saw this during COVID in 2020. President Trump got up, declared that people didn't have to pay their rent or their mortgages, and then didn't do anything. There was no follow-up at the time. Folks in the mortgage industry kind of looked at each other funny for about 60 days and said, what's going to happen? Because they have to advance principal, interest, taxes, and insurance to protect the house. The first rule in mortgage finance is protect the asset. But it all worked because the Fed dropped interest rates to zero, and we had a boom. We refinanced 2/3 of every mortgage in the United States.
Right.
And that cash flow allowed them to finance forbearance for millions of Americans. Now, the unfortunate part, of course, was home prices went up double digits for 6 years. So that's why we have no affordability today. So, it helped, but it certainly didn't help in some ways.
Mortgage loan forbearance back in the COVID era about 5 years ago, where you could basically just skip your mortgage payment and then they increase the overall duration of your loan period.
That's right. So, your government market, your conforming market were fine. They also had various schemes, state forbearance for non-agency loans. Nobody thought at all about the multifamily sector and the developers that didn't get paid for 2 years. And we're feeling the impact of that, of course, today. That's probably the biggest pain point in U.S. economy today is commercial real estate and multifamily real estate. And neither one of them involves a consumer, so it gets no attention at all. You read about it in the specialty press, but that's about it.
And by talking about multifamily not affecting the consumer, you're just talking about who's on the owner side there?
Precisely. If the consumers have problems, you'd hear about it. And you do, yeah, especially in some of the blue states. I live in New York, so we have some of the more aggressive rent stabilization, rent control laws in the country. And they go back to World War II. They go back almost a century.
Right. It's those people in the 1 to 4 unit space in residential real estate investing that really got the help there.
Well, at least, the world didn't end. Imagine if all of those people had gone to foreclosure. The industry wouldn't have done that, of course. They would have thrown up their hands and cried for help. But the point is they made it work, but the cost of making it work, that zero interest rate regime that the Fed put in place, is still being felt today. If you look at banks, which typically have prime large mortgages on their books, the loss given default is zero. Home prices are so high that if somebody actually goes to foreclosure, they sell the house, they pay off the loan easily, and there's usually a large residual left, which would go to the homeowner. So today, if somebody gets in trouble, we'd do a short sale, we'd do a deed in lieu, and off they go. And that's why the stats don't show you the pain that many American families are feeling today, because about 60% of all payoffs of 1 to 4 family mortgages are people who are exiting the market. They're not going to buy another house. So what that means is that the cost of home ownership or whatever other factors are involved has made them make the decision not to go to another home mortgage.
Yes, we have this historically low affordability that's beginning to be reflected in the home ownership rate. It's trended down from about 66%
Yeah.
to 65% recently. We continue to be in this environment here, Chris, in the 1 to 4 unit space where those existing homeowners are in really good shape. They have record high equity levels of over 300K. A lot of them have their home paid off. About 40% of American homeowners own their home free and clear. And of the remainder, those borrowers, 82% still have a mortgage rate of under 5%. And of course, that
Nice.
principal and interest payment stays fixed. So even if there's economic hardship, it's pretty easy for people to make their payments and stay in their homes.
Well, it certainly is for most of the marketplace. If you look at the bottom 20%, the FHA market, also the VA market, there's a little more stress there. There's still an awful lot of people who are in various types of forbearance in that market. That's going to end in October. So the Trump administration is pushing most of the rules back to pre-COVID approaches for delinquency, for example, what we call the waterfall. And what that basically means is that if an FHA borrower gets in trouble, they'll have one shot at a modification where they lower the loan cost and stick part of the loan out the back to be paid off when the house is sold. If that doesn't take, if they don't reperform, then they're going to go to a foreclosure. We just ended another program for veterans. They had 3 weeks notice. So now you're going to see a lot of veterans go into foreclosure, unfortunately.
Yes, this administration is basically making sure that people are responsible or resume their payments. We've seen that
Oh, yeah.
student loan repayments needing to resume as well. Most foreclosure rate types are still pretty low, but yes, FHA foreclosure rates are higher than those for conventional loans.
Yeah, the interesting thing is the veterans' delinquency rate is half of the FHA rate. And even though people in uniform don't make a lot of money, they pay their bills.
Yeah.
So it's quite striking.
Why don't you talk to us more about areas where you see distress in the housing market before we talk about more inflation, Chris?
The key areas of housing stress at the moment are commercial real estate that has become underutilized. COVID drove a lot of this, but also the fact that industries could change their work practices. They could have people work from home. Look at housing. We sent everybody home in 2020 while we increased headcount by a third to address a surge in lending volume. It was insane. I got to tell you, we were hiring people that we didn't see for months. That changed the business model assumptions for a lot of industries. A lot of them moved out of blue states and went down to Florida and Texas, in the mortgage industry particularly. And so we have a lot of older real estate, particularly, that is suffering. It has dropped in terms of appraised values. You also have higher interest rates and higher cap rates. That is to say, the assumption of returns on the part of investors. So that hurdle has made a lot of these properties impaired, essentially. And then the other subclass is older multifamily properties. Think about those beautiful old apartments in the middle block up on the east side or the west side of Manhattan. They're not big enough to be viable. And so they have become this kind of subprime asset class, much in the way, if you recall the Signature Bank failure, they typically bank these sorts of real estate properties, and now there's nobody that wants them. I think you're going to see some very specific pain coming out of HUD and also Fannie Mae and Freddie Mac because they bank some of these smaller properties that really aren't bankable by commercial banks. That's what it comes down to. You're going to read about this and hear about it a lot in the commercial market over the next several years. And again, the losses on bank-owned multifamily properties today are averaging 100%. So that means that there are a lot that have more expenses than simply losing the full loan amount. And, if you have a bank loan, they're not taking these properties. They don't want them.
Right.
So the bank REO rate, if you look at the data from the FDIC, is zero. And what that tells you is that they can't sell the properties. They don't want them because if they take ownership, the city's not going to let them abandon the property. They'll have to keep it and maintain it. It's a tough situation. This has evolved over the last 20 years or so because consumer incomes have been kind of stagnant in real terms, but the cost of operating a property in New York City is not going down. It's going up quite a lot. And the legislation we've seen from Albany doesn't allow owners to recapture expenses, doesn't allow them to renovate apartments. So if I have a rent-stabilized apartment, I'll use a real example in a beautiful building on Central Park South, right? To renovate a unit that's been occupied for 20 years, new kitchen, new bathroom, everything, services, that's $150,000. So if I'm the owner and I can't recapture that cost, what do? I lock the door. I gut the apartment and I lock the door and I hope that the laws will change in the future because I can't rent it. My insurance underwriter will not allow me to rent an apartment that's not brought up to code. That's New York law, but the folks in Albany don't care about that. We have some really unreasonable people in positions of authority, unfortunately, in some of these states. And you talk to them about these issues and they don't care. They just pander to consumers, regardless of whether or not it makes sense or not. And that's just the way it is.
Those evil landlords, quote unquote,
That's right, evil landlords.
They're just mom and pop investors that are trying to beat inflation with real assets, and they have real expenses.
Precisely.
Rent stabilization basically just being a genteel term for rent control, which gives no one an incentive to improve a property for sure.
And it reduces the availability of housing ultimately because nobody builds. You see that in New York right now. The home market is pretty tight up to the conforming limit for Fannie Mae and Freddie Mac, so you figure 1.1 million, 1.2 million here in New York. But above that, it's quieted down quite a lot. There's compression in some of the higher end homes. And, if you go down south, you see a different problem, which is overbuilding. They didn't want to build here, so they went down to the Carolinas and Texas and Florida. There's a huge amount of both multifamily, condo-type developments and single-family homes, too. But above that average price level, way above $500,000.
Sure, it's made this dynamic where things have been flip-flopped. In the Northeast and Midwest, where the populations aren't growing very fast, those markets have been appreciating more than those in the high-growth Southeast, all coming back to supply. They're not bringing on enough new supply in the Northeast and Midwest. Chris has just laid out a few reasons for that due to this high regulation. And then in the Southeast, a high-growth area, even though that's where people are moving, we're not getting much appreciation there because you're able to build and that supply is able to keep up with demand. Well, Chris and I are going to talk more about the housing market and about inflation when we come back. You're listening to Get Rich Education. Our guest is Chris Whalen, the author of a great new book. I'm your host, Keith Weinhold. The same place where I get my own mortgage loans is where you can get yours, Ridge Lending Group, NMLS 42056. They provided our listeners with more loans than anyone because they specialize in income properties. They help you build a long-term plan for growing your real estate empire with leverage. Start your pre-qual and even chat with President Chaley Ridge personally. While it's on your mind, start at ridgelendinggroup.com. That's ridgelendinggroup.com. You know what's crazy? Your bank is getting rich off of you. The average savings account pays less than 1%. It's like laughable. Meanwhile, if your money isn't making at least 4%, you're losing to inflation. That's why I started putting my own money into the FFI Liquidity Fund. It's super simple. Your cash can pull in up to 8% returns and it compounds. It's not some high-risk gamble like digital or AI stock trading. It's pretty low risk because they've got a 10-plus year track record of paying investors on time, in full, every time. I mean, I wouldn't be talking about it if I wasn't invested myself. You can invest as little as $25K and you keep earning until you decide you want your money back. No weird lockups or anything like that. So if you're like me and tired of your liquid funds just sitting there doing nothing, check it out. Text FAMILY to 66866 to learn about Freedom Family Investments Liquidity Fund. Again, text FAMILY to 66866.
This is the Real Wealth Network's Kathy Fettke, and you are listening to the always valuable Get Rich Education with Keith Weinhold.
Welcome back to Get Rich Education. We're talking with the author of a great new book, Chris Whalen. It's called Inflated: Money, Debt, and the American Dream. Chris, I see the residential housing market and their price points as being resilient. I'm kind of looking around and seeing if you have any places where you think that there are any cracks in that. I've heard you talk elsewhere about a housing price correction. Were you talking in the 1 to 4 unit space? And how do you think that could happen?
I didn't come up with that idea. I did a biography of my good friend Stan Middleman, who's the founder of Freedom Mortgage. It's a real rags to riches story of a successful entrepreneur. A great guy, by the way. He's a beloved man in the mortgage industry. And so what he believes is that cycles are about a decade in terms of human behavior. And he says misery on the eights, which is kind of a cute way of saying it. And what Stan is basically saying is you eventually see so much price appreciation that affordability goes to zero. You run out of buyers, is another way to put it. And then once the Fed gooses it, he thinks we see an interest rate decline this year, next year perhaps. You get rates to run a little bit. You get volumes to jump the way they did last summer. You remember in the third quarter, we had great volumes in the mortgage industry, carried everybody through to the end of the year. And then after that, he says we get a price correction, maybe back down to 2020, 21 levels. So we're talking about a 20% price correction, and we're talking about the loans that have been made in the last few years being underwater. That's something we haven't talked about in a long time. We haven't talked about that since 2008. So I think that Americans inevitably have to see some kind of a correction. What the Fed did was wrong. What they did was excessive. I write about that in the end of my book. But unfortunately, the result is home prices that have galloped along, and eventually you got to reset it. Part of it's supply coming online. Part of it is simply, like I say, you run out of buyers. And when it's simply that purchase buyer who is either all cash or happens to have the deposit, and that's all you have, and there's no flexibility for people that want to get into the market, that's tough. I could recall Paul Volcker years ago. We talk about that in the book too. He ratcheted down home prices. He raised interest rates so much that home prices went down. And a lot of builders went out of business who had a lot of S&Ls go out of business in the previous decade. So that was a tough time. We didn't even start to do that this time around because they were afraid to. The Fed is worried about keeping the Treasury market open, so they are afraid of deflation, which unfortunately means you don't get those opportunities to get into the market. I remember my parents, when I was very young, they would buy busted homes in Washington, D.C. It was a great way to make a lot of money, and in 5 years, the house would double. That's the kind of market Washington was.
In my opinion, I don't see how there could be any substantial residential home price correction. Historically, that happens when there's a wide swath of homeowners that get into financial trouble. Like I was talking about earlier, the homeowner is in great financial shape today. In fact, since World War II, we've only seen home prices drop substantially during one period. That was that period around 2008, and that's when we had conditions that are opposite of what they are today. We had loans underwritten with liar loans, and we had an oversupply of homes. Like I was saying earlier, inflation can't touch one's principal and interest payment. We're still undersupplied with homes. Most experts don't think we'll get that into balance for at least 5 years. I really don't see how home prices could fall substantially. I also don't see how they could rise substantially, like say 10%, due to that low affordability, but I expect continued stability in prices.
Well, we'll see. I'm not as sanguine about that because a lot of people feel house rich on paper, but when the bottom of the stack is really hurting as it is now, FHA delinquency rates really are in probably the mid-teens. You don't see that yet in the middle with the 720, 740 FICO type borrowers, but I think over time you could. And again, it depends on the economy and some other factors. But I'll tell you right now, you're already seeing a correction in the high end. The bottom half, no. And there's a supply problem here, which I agree with you on. It's going to keep those home prices pretty firm. And even where I am in New York, for God's sake, Keith, there's no construction here. So we just had a house across the street from me go from 1,000,001. I live in Sleepy Hollow, New York. And, this is typically around the conforming limit for prices for most of these homes. And it went for $150,000 over the ask. It was crazy. It went in 2 weeks. Now, during COVID, we saw this sort of behavior, and we thought, well, okay, you had zero interest rates. I got a 3% mortgage, by the way.
Awesome.
But here we have a situation when markets cooled down a lot, and yet the lack of availability is really the driver. So in that sense, I agree with you, but I do think the high end could correct rather substantially.
And of course, in multifamily apartments, that's different. That's where values in a lot of markets have been depressed by more than 30%. They were subject to those interest rates being jacked up, and we're still going to see balloon loans mature and people default on those in apartments. The pain is not over with there, but at some point that's going to bottom out, and that'll be a buyer opportunity in apartments.
Well, the thing is, new stuff is going fine. It's what happens is when the new gets built, the older assets down the road get discounted. That's really what's going on. People love new, as you know. These kids love a new house as opposed to an older house.
Yes, that'll help reset the prices in the new market when you can compare those to what existing values are. Well, Chris, talk to us more about your new book and what the overall thesis of the book is in these critical times.
Inflated is meant to help people understand how our country went from agrarian, sleepy, isolationist America in the 1900s to being the dominant economy in the world and the provider of global money. We talk about how we got here. We talk about Abraham Lincoln and Franklin Roosevelt and many other characters. Obviously, we had to talk about Andrew Jackson, who is now embodied in our president, Donald Trump. We try and frame how this is all going to evolve in the future. And my thesis is basically the global currency role is something you get during or after a war. We took the baton from Great Britain after the First World War. And then by the end of World War II, everybody in the world was broke except for us. We were the last man standing. And so rebuilt the world. We let everybody take advantage of us. And now, president who's saying, nope, we got to change this. I think if it wasn't Trump, it would be somebody else, to be honest with you. Americans are tired of high inflation. They're tired of some of the other costs that come along with being the global reserve currency. So we try and frame all of this in an understandable way. And I particularly talk about housing during COVID and how that all really, I think, changed things for many Americans. Home ownership has been one of the basic ways we create wealth in this country. And the fact that we didn't have an opportunity for people to get in cheap with a fixer-upper or a house that was foreclosed, I think is unfortunate. But the system just can't tolerate it. We've gone in 2008 and then in 2020 through two very significant crises when the government bond market stopped working. So we talk about that as well.
I don't predict interest rates. I think it is really difficult to do. You mentioned earlier about the prospect for lower interest rates coming. Everyone wants to know about coming. What's your outlook for the future of interest rates and inflation for just say the next 5 years, Chris?
I think interest rates will drop. That is to say, what the Fed controls, which is short-term interest rates, in the next year or so, we'll have a little bit of a boom as a result. But I think the concern about the federal deficit and U.S. debt, the volatility caused by President Trump's trade strategy, and just general, I think, a sense of uncertainty among investors is going to keep long-term interest rates higher than we saw during COVID and really the whole period since 2008. The Fed bought a lot of duration and took it out of the market, so they kept rates low. They're not going to do that as much in the future. I don't think they'll buy mortgage securities again. They're very chastened by that experience. So if they don't buy mortgage-backed securities, and if the banks don't become more aggressive buyers, and I don't think they will, then, the marginal demand that would drive mortgage rates down is just not going to be there. Banks have been holding fewer and fewer mortgages and mortgage-backed securities on their books for 35 years. If you look at the growth in the industry, the dollar amount of 1 to 4 family mortgages hasn't changed very much. So when you look at it that way, it's like, what's wrong? Two things. They want to only make mortgages to affluent households. They want to avoid headline risk and litigation and fines and all of that. And I think also, too, some of the Basel capital rules for banks discourage them from holding mortgages and mortgage servicing rights, which is an area I work in quite a lot.
It seems to me like increasingly the powers that be, the United States government, just won't let the homeowner fail. They want to do so much to promote home ownership. Over the long term, we see relative ease with getting a mortgage. We've seen lower down payment requirements during other times, including COVID. We see the government jump in with things like mortgage loan forbearance and an eviction moratorium for renters. They just don't want to let people lose their homes. It just seems like there's more propensity to give homeowners a greater safety net than ever.
Well, we've turned it into an entitlement.
Yeah.
President Trump is changing that at the federal level. The states, the blue states, are going to continue to play that game at the state level, and they can even have state moratoria. But what's going to happen, and I think sooner rather than later, is you may see the federal agencies start to tier the states in terms of servicing fees simply to reflect the cost. It takes over 1,400 days to do a foreclosure in New York.
Gosh.
That is a big problem. You can lose the lien in New York now. It takes so long. So I think that, from an investor perspective, from a developer perspective, it's not an attractive venue. That's just the reality. Then even California, as progressive and as activist as it is, you can still get a foreclosure done very quickly using the trustees. It's just a totally different situation. If there are complications, you can get into a judicial foreclosure, which will take longer. But still, California works. New York is deliberately dysfunctional. We have people in the state legislature who are in foreclosure themselves, and they keep passing these laws. So, I think at the federal level, you're going to see it roll back to pre-COVID. But I will say that forbearance, both with respect to the agency and conventional market and private loans, is kind of the rule now. We work with the borrower much more than we would in the past. It is really night and day.
Chris, your new book has gotten a lot of acclaim. Let us know anything else that we should know about this book, and then if we can get it in all the usual places.
You can buy it at Barnes & Noble, Amazon. I have a page on my website, rcwhalen.com, with all the relevant links. But the online is the best way to get it. Most of the sales are on Kindle anyway, but well over 90% are online, so we don't have to worry about physical books. I think we'll be doing some book signings in the New York area, so we'll definitely let you know about that.
One last thought is that the rate of inflation means more to a real estate investor than it does to a layperson, maybe 5 times as much or more, because when we borrow for an income property, our asset floats up with inflation. That part's really just a hedge on inflation. Our debt gets debased by inflation, which is really a mechanism for profiting from inflation over time. And then thirdly, our cash flow tends to go up even faster than the rate of inflation since our principal and interest stays fixed. So real estate investors can often be the beneficiary of inflation. It's sort of strange to go root for a force like inflation that can impoverish so many people. But what are your thoughts with respect to real estate investors and inflation?
Well, it's funny when Jerome Powell at the Fed says that they have a 2% inflation target. My response is, well, we better have at least 2% inflation if we're going to make commercial real estate work. Commercial real estate went up for 75 years after World War II. I can remember when I was in the rating business at Kroll Bond Ratings, going to see some of the banks here in New York. Their multifamily books had only seen the equity underneath the asset go up and up and up. In other words, the land ended up being 90% of the value, 15, 20 years after the purchase. And the improvements were almost worthless simply because the land appreciated so much. Now, that has changed. Since COVID, a lot of commercial real estate particularly has gotten under a bit of a cloud. You've seen falling prices. However, in parts of the country that are growing, where you have a positive political environment, positive economic environment, you're still seeing fantastic growth in both commercial and multifamily markets. So I think being very careful and patient and doing your homework in terms of picking venues is more important now than ever before. I'll give you an example. Down in Florida, we're building new malls every day. The mall down the road that's 15 years old, there's nothing wrong with it, but it's 15 years old. And so the price discounts that you're seeing for existing assets are rather striking. Same thing down in the Carolinas, down in, Atlanta, and going down into Texas, growth spectacle. I'm always astounded by what's going on in Texas. They've built so much in that whole area around South Lake, out by the airport. They're going to basically subsume Houston. So, in those markets, you have great opportunities, but you also have overbuilding. And so we're going to see some cycles where there are going to be deals out there for projects that maybe were a little too ambitious, have to get restructured, and astute investors can come in and do very well on that.
Like we often say around here in real estate investing, the market is typically even more important than the property itself. The name of Chris's new book, again, is Inflated: Money, Debt, and the American Dream. It has an awful lot of intersections with real estate investors and how they can play inflation. Chris, has been a terrific conversation about the real estate market and larger market forces. It's been great having you here on the show.
Thank you, Keith. Let's do it again.
Yeah, some good insights from Chris, a smart guy. And gosh, what a really sad state for rent-stabilized apartments in New York City, where landlords of some of those properties, they would have to spend sometimes hundreds of thousands of dollars in order to bring them up to code, but then they couldn't charge enough rent to offset those expenses due to government intervention and price fixing. So landlords just lock up the property vacant. And this sort of harkens back to when we were talking about some of this last year when we had documentary filmmaker Jen Sidorova on the show with her film called Shabification. And it was about how rent control slowly makes neighborhoods fall into disrepair. All right, Chris and I had some difference of opinion there on the prospects for a home price correction. I think I made most of my points. He did, though, talk about running out of home buyers. If I have him back, maybe I'll pick up right there. More buyers are baked into the demographics. Like I think I shared with you one time, the U.S. had its highest ever birth rate years between 1990 and 2010. More than 4 million births per year for a lot of those years. Just to review this with you, you might remember that 2007 was the U.S.'s peak birth year. Add 38 years to that for the average first-time homebuyer age, and that housing demand won't even peak until 2045, and it will continue to stay high for a few years after that. So that's where the demand is just going to keep coming from, just piling on. And when I say that loan conditions have eased for American homeowners like I did there during the interview, of course, what I'm talking about is the long term. I mean, lending conditions got more rigid after 2008 and with the adoption of Dodd-Frank. What I'm talking about is before the Great Depression, it was most common to have to make 50% to 60% down payments on property, and you had to repay the entire note in 5 to 10 years. I mean, can you imagine how that would hurt affordability today? And then later, by 1950, 15-year loans were the common one. I mean, even that would impair affordability today. Today, 30-year loans are the common one, and you can put as little as 3% down on a primary residence. A lot of people don't know that either. It does not take 20% on a primary residence. So that's what I mean about the relative ease of credit flow today. Now, Chris has knowledge about other parts of the real estate market that I don't, for his work inside D.C. and in other places like the foreclosure market. We talked about some of that right after the interview. For example, he was letting acronyms like NPL roll off his tongue, and I had to ask him what that meant. That's a non-performing loan. Check out Chris's new book. Again, it's called Inflated: Money, Debt, and the American Dream. And again, his website is rcwhalen.com. And Chris also has a great sense of history, which we didn't get into. Longtime Real Estate Guys radio show co-host Russell Gray and I will discuss monetary history here on the show soon. Like I said, I'm coming to you from Edinburgh, Scotland this week. Even if you don't see great sights, it's interesting just walking the historic streets here. If you're an American that's visited here before, you surely know what I mean. And I told you that I'd let you know the current real estate transaction I'm involved in is paying $650 a night for the hotel here in Edinburgh. Yes, that's a lot. I've actually paid less for fancier places in Dubai, but This hotel here is on the Royal Mile. Of course, I could have found less expensive accommodations elsewhere. Speaking of less expensive, here's an announcement. We have new investment property providers at GRE Marketplace, 2 of them. The markets are both in Oklahoma, and they are Oklahoma City and Tulsa. Oklahoma as a state is known for landlord-friendly eviction processes and legal systems, kind of the opposite of New York. So this makes your property management more predictable. Now, when we look at this city, OKC has the lowest priced new single-family rentals I can think of, at under $160K. Yes, that really puts the exclamation point on inexpensive and favorable rent-to-price ratios, often exceeding 1%, which is obviously attractive for cash flow, meaning a $150K single-family rental could yield over $1,500 in rent. There's high rental demand in certain submarkets. We have scouted out those exact places for you in the OKC metro, like Edmond, Moore, spelled Moore, and Midwest City, all supporting consistent rent income. Though it was once really oil-dependent, OKC has diversified economically, reducing your risk tied to commodity cycles, and OKC's local economy is supported by industries including aerospace, energy, healthcare, and logistics. Then there's Tulsa. Tulsa has the highest cash-flowing new-build duplexes, perhaps anywhere in the U.S. that I know about. On the single-family rental side, a lot of Tulsa investors can find properties under $150K, with monthly rents again exceeding 1% of the purchase price. Clearly ideal. So yes, both Oklahoma City and Tulsa are now on GRE Marketplace. You can either visit the pages and see them there, or one of our qualified, experienced GRE investment coaches. Meet with them. They can help guide you to the very best deals and show you the specific property addresses available right at this time for whatever best meets your needs. If you're looking to either start or expand to another market and you seek cash flow, you really need to consider Oklahoma. Yes, it is free to have a strategy session with an investment coach, whether that's for Oklahoma or other investor advantage regions. I often like to leave you with something actionable. You can start at greinvestmentcoach.com. Book a meeting for a free strategy session remotely. That's at greinvestmentcoach.com. Until next week, I'm your host, Keith Weinhold. Don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
You know, whenever you want the best written real estate and finance info, oh, geez. Today's experience limits your free articles access, and it's got paywalls and pop-ups and push notifications and cookies disclaimers. It's not so great. So then it's vital to place nice, clean, free content into your hands that adds no hype value to your life. That's why this is the golden age of quality newsletters, and I write every word of ours myself. It's got a dash of humor, and it's to the point because even the word abbreviation is too long. My letter usually takes less than 3 minutes to read, and when you start the letter, you'll also get my 1-hour fast real estate video course. It's all completely free. It's called the Don't Quit Your Daydream letter. It wires your mind for wealth, and it couldn't be easier for you to get it right now. Just text GRE to 66866. While it's on your mind, take a moment to do it right now. Text GRE to 66866. The preceding program was brought to you by your home for wealth building, GetRichEducation.com.